Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Seems like it's been a long time. I don't know. This week seemed really long for some reason. I have no idea why, but I think it's probably because we're getting close to the end of the year. And one of the things that it's been pretty challenging since the pandemic. I mean, before the pandemic, I don't remember it being quite as bad, but people are waiting until the very last second to try to take their required minimum distributions. And let me give you some advice. Don't do that. The custodians are not guaranteeing that you will get your RMD, and the penalty is 50% of what you were supposed to take out. That's a big penalty, very stiff. So if you haven't requested your RMD, you need to get it in now. One of our biggest custodians is they won't guarantee that it gets processed if you turn it in later than last Friday or yesterday. So it doesn't mean you can't. And in fact, I know Melissa has begged and pleaded in the case of a lot of our clients and has gotten things done that they said they wouldn't do. And thank you very much there, Melissa. And but I'm telling you, do not wait. The amount that you have to take out was established last year at December 31st. Okay, that's the amount. And it's not that big of a deal. If the market were to go up 10%, it might add 0.4%. And that's if the market went up a full 10% in a month. Okay. So just don't do it. It just doesn't make sense. It's kind of like, a lot of people get hooked on taxes. Oh, I don't want to pay any taxes. Okay, well, you know what the easiest way to pay the least amount of money in taxes is? Don't make any money. That's it. If you've got investments, you're probably going to have to pay taxes sooner or later. And there's an old saying, don't let the tax tail wag the dog. That means taxes, are they important? They are important. They're not the only thing that you should be thinking about. And unfortunately, a lot of people make the mistake of trying to avoid taxes, and it ends up costing them more in the long run. So I'm not saying you should ignore it. That's not what I'm saying at all. But it shouldn't be the number one priority is to pay the least amount in taxes, because oftentimes that can lead to some pretty crappy mistakes that are incredibly difficult to make up for. Just like waiting until the last second and then you don't get your RMD on time, and now it falls into the next year, and sometimes you can end up paying some big penalties for that. Now, every case is a little bit different. If you had to take it out this year and you missed it, you can still wait until tax filing deadline, take it out, but then you're going to have to take 2 out this year. You'd have to take out another distribution. So in every case, a little bit different. That's one of the reasons I guess I still have a job. And as a financial advisor, I'm actually an investment advisor, and a lot of people don't know what the difference is there. So we've had to take courses in investment planning. We've had to take courses in how to be a good fiduciary. Those are not required, by the way. Those are optional. And throughout my career, I basically, instead of looking at a lot of the financial planning stuff, which is fine, but I'm going to tell you, somebody that holds themselves out as a financial planner, you got to be careful, because the financial planning college has you looking at homeowners insurance. It has you looking at employee benefits. It has you looking at life and health, and those are fine. Health insurance. You ever see a health insurance policy? I mean, if you're not specializing in that field, you're probably doing people a disservice. There are things that you're missing. I know enough about it to know, I don't want to go down there. I don't want to do that. That's like, a podiatrist saying, I'm going to, let me look at your ears, nose, and throat. They're not the same type of doctors. They've both gone to medical school. They both have degrees. It's a different field. And that's what I feel. I feel really bad for the people that are getting close to retirement or people that are already retired, because they've added so much legislation that it really requires specialists in a lot of different areas now. And in fact, I have a guy. I didn't get permission to use his name, so I'm sorry about that. But if you call, I can give you a referral to him. And at some point in time, I'd like to get one of his staff on my radio show. But they're specialists in Medicare supplements. That's a big deal. That is a really big deal. The supplemental insurance is expensive. Why? Because it's necessary. I mean, otherwise you run the risk of, running out of money. There's no cap on what you could potentially have to spend. Now, is that common? No, but does it happen? Yeah, it happens. So anyway, at some point in time, I'll have him on the show, because I really think that that's an important part of anybody that's getting ready to retire. They need to take a look at that, figure out what your options are, and you need somebody who specializes in that area. I know enough about that to know that you need a professional. That's how much I know. And by the way, I have a life and health license. I mean, I am licensed to sell those products, and I don't. Why? Because I know enough to know that I don't know. I know enough to know that you really need to get somebody special. And here are the people that you need to in today's environment, as far as I'm concerned. And this is America. You're free to your own opinion, and this is just mine. Mine is you really need a good tax advisor, somebody who just does taxes for a living. Why? Well, because there are 10,000 pages in Internal Revenue Code, and I'm pretty sure that's just for individuals. When you start adding corporations, LLCs, and all that other stuff, it's a vocation now. They've turned it into a vocation. Does that mean that you can't go out and buy your own tax software and do it yourself? Heck no. You can do that. You can fix your own car, build your own house. Anything's available on YouTube if you've got the time, effort, and energy. But don't make a mistake, because that could be rough. So I figure you probably need to have somebody who does taxes for a living to do your taxes. You also need an estate planning attorney, somebody who does estate plans. Now, there are a lot of attorneys out there. You don't want somebody who's a litigator for big corporations doing your estate plan. Again, not that happens very often, but if estate planning is not something that they do fairly frequently, then I would probably try to find one that will. And fortunately, I've been around long enough to be able to refer people out to the people that actually specialize in that area. So if you're looking for one, heck, I'll refer you to mine. And I was lucky to get mine, by the way, because he was one of my clients, estate attorneys, and this guy's was a direct descendant of one of the families that founded the Cleveland Clinic, and so this guy knows his stuff. I hope he doesn't retire anytime soon. But so anyway, you need an estate planning attorney. You need somebody that can do your taxes, and I know it's really hard for some people. There are more people now that are millionaires than there ever have been. And well, you've got $1 million in America. There's a pretty good chance. There's at least a 1 in 2 chance that you've been married once before. You want to talk about complicated. Holy cow. You need somebody. And this is another service I feel like we provide to people that they may not be getting elsewhere. We'll refer them to several estate planning attorneys. Let them pick. And my suggestion is get on the phone, call them, tell them what you're looking to do, get a feel for what kind of pricing they're going to have. I know they hate when I say that, but so do I, by the way, but that's tough. And if you like the person, that's going to be very meaningful. Go in and talk to them on the phone first, but when you go in, make sure that you actually kind of get along, because these are really tense items that you're going to have to deal with. There's a lot of psychological pressure involved in doing an estate plan, especially if you've been married before. That's really tough. So the ones that haven't been married before, that's hard too. I mean, how do you, maybe you got a son-in-law that you really don't like, and you don't think he's a very nice person, and you'd like to do something about that. You want to make sure that he never, gets a dime of your money. Maybe it's a daughter-in-law. Who knows? Maybe it's a grandkid. You want to set up a trust, and because you don't want the grandchildren that you left as beneficiaries to be handling the money. You want to make sure a trustee handles the money for them, because you're afraid that they might blow through all the cash. So that's every situation, everybody's family situation is going to be a little bit different. And it's one of the nice things about having a lot of experience in the industry. I mean, most of this stuff you can't learn in a book. Personalities, issues with personalities. None of the courses I ever took really talked a lot about that. And but you find out in the real world really, really quickly. And you got to have the right personality to be a good investor. That's one of the hard things about being an investment advisor is trying to get to know what somebody's real ability to take risk is. And, we've got questionnaires. I think mine's probably one of the simpler questionnaires. And, but when push comes to shove, I've seen a lot of people, they're brave when things are going up and things are doing well. And then when they start to correct like they're going to from time to time, they fall apart. You can't do that. You got to stick to your plan. Another reason to have an advisor, stick to the plan. People call and, they oftentimes over the years, I've had people, accuse me of being Pollyannish because I'm always, looking on the bright side. Well, you know what? It's been pretty bright past couple hundred years. Now that may change. It could change, but I doubt it. When you look at why, what's been driving the economy, what's been allowing people to, by the way, your pensions, incidentally, the pensions that you get, if you're lucky enough to work for a government agency or you work for a school district or a city, they have very good pension plans. Huge. And had I known about that before, I didn't learn about that until I was almost in my 30s. Okay, it was too late for me to go back to school then become a teacher because that's what I would have liked to have done. Yeah, I just didn't think they made much money. I had no idea what their pensions were like. I had no idea that the schools contribute on their portion. You're not contributing this. They're contributing. You teachers out there. It's around 20% of your gross income. It's around 20%. And then you have the 403B that you get to add to. So I've got teachers that have well over $1 million. I mean, one of them had two. She passed away. But the $2 million, a school teacher. And that was a long time ago. The equivalent today would probably be about right around $3 million. To accumulate $3 million in net worth as a school teacher. So don't say it can't be done, because I've seen it, and it's good to know. It's really good to know. And the pensions you have out there. When you look at the 4% rule, how much money should I take out? This is part of retirement income planning. There's a rule called the 4% rule. You can look it up. But basically it says you probably shouldn't plan on taking out more than 4% your first year. Okay. Because over time, as inflation increases the amount that you have to spend to maintain your style of living, you're going to have to take out more than 4%. But if you start out higher than 4%, you could be in trouble if inflation really ran away. And one of the reasons I'm talking about this today is inflation is higher than it's been in 40 years. And so that 4% rule, you're looking at, at some point in time, you're probably going to have to increase the amount that you're taking out, which is really rough because the high inflation normally causes really rocky stock markets. When you look at how the stock market has, what the returns are during a highly inflationary period, not very good. And it's one of the reasons that it starts out so low at 4% is because when they ran those tests to see what would be this quote unquote sustainable, incidentally, I've got a software package that's provided by one of the biggest asset managers on the planet. You put your name in there and your age, and you can put your Social Security in, and how much you save for retirement, and it'll tell you what a sustainable, or in other words, what a reasonable retirement income would be. And that's one of the services that we provide to anybody that has an account with us, and it's free. And if you'd like to see what that's like, just hit me up with an email, send me, or give me a phone call, and I can actually do it fairly quickly. I can do it in my head now. I've been doing it for so long, and so not too bad. And also, it'll tell you, it'll show you the various levels depending on how risky or aggressive you want to be with your portfolio. And I think that's a nice tool. It's a nice tool to have. How much can I reasonably expect to generate from my investments? And one of the reasons I bring that up is you get an awful lot of people who come in and they've read something somewhere, and a lot of times it's Kiplinger magazine, which I have a copy of with me here, and they've overstated the amount of money that is safe to take out. And that's because the people that are writing that are journalists. They're not advisors. And I'm sure a lot of people don't understand that the people that write for a magazine are journalists. They're not, and some of them are, they'll have articles published by financial professionals, and you can always tell because they're typically more accurate, and they don't try to grab the eyes with sensationalism. They're out there, and I'm sure that's probably why they don't write nearly as many of the articles, because a lot of people find them kind of boring. But boring is good, especially when it comes to retirement planning. I want to be bored to death when I look at my retirement plan. Oh, yeah, okay. I hear the music. I got to take a real quick commercial break. This is Bill Bullington. Stay tuned, because I'll be right back. Back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to reach out to me, my website is bullingtoncapital.com. I'll be glad to try to help you the best way I can. And, it's interesting. I was thinking, and I was talking to someone this morning about my dad, who had passed away here a couple of years ago, and was just such a nice guy, such a hard worker. We used to go out, and we would build a garage, 16 by 24, 16-foot garage door, windows, side entrance doors, and all the siding, the roofing, the whole thing. The three of us would get that done before 3 o'clock in a day. So we would start from a pile of lumber and everything you needed to build that garage, and we would be done that day, actually with a couple hours to spare, and we did not use nail guns. We drove every nail by hand. Now I know, and by the way, when I was in college, I did some roofing. I just started my own little roofing company, and I had a buddy that we both worked at this one restaurant together. So he was a painter, and he would only work at the restaurant on weekends. And I went around and got contractors insurance, which is hilarious, by the way, because I got general contractors insurance for literally a quarter of the cost to get roofers insurance. Because roofers, you're on the roof, there's a lot of more liability there, but it still covered the roofing stuff. So, and this guy was actually during the week, we worked these jobs on the weekend just to get extra money, but he was a painter. So I formed the PR company, the painting and roofing company, got a tax ID number and all this stuff. When I was in college, I went to a Kinko's, which is actually the FedEx office now today, or the FedEx stores. They bought Kinko's out. I sat down there on a Mac computer. It took me a couple of hours to figure out how to make a flyer. I had never done that before, and I'd never used a Mac. I mean, we're talking about the 1980s, so they were relatively new back then. Probably 12 or 15 years old, somewhere in that neighborhood. But most of us didn't have computers, and nobody had heard of the internet because Al Gore hadn't invented it yet. So I went door to door passing those things out, and he would do the painting jobs, I would do the roofing jobs, and it was hilarious. I was next to these guys. They were using nail guns, and I was carrying, and they had these things that would carry their shingles up, and I'm just going up and down the ladder and doing it by hand, and I would hold back because my dad taught us so well. And by the way, he was a perfectionist. It wasn't good enough to be fast. You had to be really good, or you were doing it again. You were going to pull it out. And he never yelled. He just said, I needed to take that down and do it again and do it like this. And so you would learn after you took something down that took you the past hour, and you're going to take it down. It's probably going to take another hour to take it down and another hour to put it back up. You would pay attention. And so I paid attention. And I was betting these guys that I could beat them up on one run. The roofs, the houses were nearly identical, so the roofs were the same size. And I kept holding back, and they got mad the first time I beat them. So I got, let's go again. And they were good. They had nail guns, by the way. I did not. And I beat them the second time. After the third time I beat them, they said, forget it. What was really funny was they went from being really upset, to being at that third time, they're just like, wow, forget it. And I bought them lunch with the money that I had won with it anyway. So it worked out really well. And just funny what you can do if you put your mind to it. And that's kind of how I go about financial planning. Okay, what's the most efficient? You got to do it right. You can't skip steps. Okay, that doesn't work. Okay, but you don't need to add a whole bunch of stuff that you don't need. And by the way, when I packed my stuff to get ready to go home at the end of the day, I was a couple ladders and gone. Those guys had to take down their fancy ladder that pulled the shingles up to the rooftop, and all their nail guns and those air compressors and all that stuff. They were there for an hour just putting their equipment back away. And so anyway, you got to be able to do the job. You got to know what the job entails, and just you don't need to bring anything extra into it. That's the one thing I really find kind of, I just don't like it. Most of the financial planners say, oh, you got to do this and you got to do that, and they have you looking at a whole bunch of things. And you're like, yeah, no, sorry. Here you go. Use the 4% rule. 4% of $1 million is $40,000. Now, that's what scares most people. 4% of $1 million is $40,000. Okay, so if you want $40,000 a year, and you want it to be reasonably attainable without a high risk of running out of money before you die, okay, you need $1 million to do 40,000. Now that's going to make that Social Security money that you are getting look like a godsend, and it is. I mean, just to replace the average amount of Social Security somebody's going to get in America when they retire, it's like $400,000 to $500,000. It's like having $400,000 to $500,000 in the bank. I mean, think about that. At $400,000, at 4%, that's only $16,000 a year. So, and why are you only doing 4%? I thought the stock market made 10%. That's its average return depending on which time period you're looking at. It hasn't averaged that in the last 20. It's not even close. And so if you were born at an unopportune time, sorry about your luck. Okay. If you'd have done the 4% rule, you could have increased it for inflation over time, and you'd still have money, still be living and still have money. So bottom line is, I don't want to add extra steps to anything, but I don't want to miss anything that's incredibly important, and that's just part of how we do business at Bullington Capital. I'll take a look at your situation. And by the way, I've been doing this for so long, I can do this math in my head. It takes me about 30 seconds to figure out how much you're going to need to be able to retire and maintain your lifestyle. Now, I will stop, and I'll show you the steps I took to get to that point, but it's really not that hard. I mean, it's really not that hard. And what happens if you're ready to retire, and let's say you have $500,000, and you were thinking, oh, it's going to take $50,000 a year out because, stock market's average 10% if you go back to pre-depression days. Well, yes, but it's averaged about half of that over the past 20 years, especially if you start at March of 2000. So you'd better be, if you're going to have a 20-year life expectancy, there's a really good chance you're going to run out of money. So I wouldn't do that. Now, by the way, since short-term interest rates have moved up quite a bit, that's really going to help. I mean, that's going to help a lot. Because right now, you can get a 4% CD, or short-term government bonds are getting close to that point. Some of them are higher than that. And if you're looking for fixed income, that's a good idea. It's one of the reasons that I started talking about fixed indexed annuities, because at the time, interest rates were less than 1% on CDs or treasuries. And the guarantees that you got from a fixed index annuity are significantly higher. They're still higher than they are for bonds or CDs. So that's an area where you need to shop around. You need to take a look, see how it's really going to fit into what you want. It's a personality thing. Yeah, you take a little bit more risk by taking the lower return of a CD or treasury. Okay, so there's more risk involved with that. Why? Because those rates can change. They can go right back down again. If the economy does fall into recession, like everybody keeps saying it's going to, by the way, Peter Lynch, if you don't know who he is, if you had invested $10,000 in a Fidelity Magellan fund when he took over, when he retired at the ripe old age of 46, I think he was in his 30s. Yeah, it was in his 30s when he started running it. It would have been $300,000. That's a lot of dough. Nobody's ever matched that record for any living portfolio manager. And anyway, but you had to. The fund was really volatile, by the way. You cannot get high returns without a lot of volatility. That's just the nature of the beast. And for a small while, you could have, like back in the late 90s, but that all went away, like in the year 2000. Computers became much more prevalent. Markets' day-to-day volatility is up significantly. And you have a lot more occurrences of drops that are like 10, 15% than you had before. And they were fairly frequent back in those days. I think it was every 12 to 18 months, you got at least a 10% drop. Once every 5 years, you got a drop that was over 20%. That was on average. It's not like a calendar. And that's another thing that's pretty difficult for an awful lot of people doing financial planning, is they want to get really exact. Well, you can't really do that with markets. It just doesn't work that way. That's why you need to ballpark it. And that's why you need to be conservative. And you need to be relatively conservative on your estimates. And I'll tell you, if they do start to raise, if they keep raising interest rates and they succeed in putting the economy into a recession, now they don't want to put it into a recession like 2006 through 2009. They didn't want to do that again. But they may not be able to help it. So it's very tricky. And if anybody knew all the answers ahead of time, then they would end up having all the money in the world and would control everything, and we'd all work for them. But so they do the best they can, and you listen to what they're saying. What they're saying right now is that we think that recession might be a little longer, that it might get a little deeper. And I'm going to tell you that the vast majority of the time, they're lagging. They're looking at things that tend to have a tendency to change after things have already changed for the better. But bottom line is, interest rates, if they were to go back down because you go into recession, and they're trying to speed the economy back up again, or trying to save the economy from staying into a recession for too long, okay, then these bond rates are going to go down. They're going to go down quite a bit. So long-term bonds at that point will go up again. They've been getting crushed, by the way, because interest rates have been doing the opposite. They've been going up. This is actually been the worst year for bonds in 60 years. Bonds have not done this poorly. If you've got a bond fund and it's not down more than 15% over the last 12 months, you're in the top 10%. That's amazing. Incidentally, those bond funds that are in the top 10%, nobody wanted to invest in them because their interest rates were like 1 or less, 12 months ago. Those are changing because a lot of those funds held on to short-term bonds, and as the short-term rates go up and the bonds that they're holding mature, their rate's going to go up. So that's why it's really important to know. You got to know what you're investing in. It's incredible. And, half the money, actually, there's 3 times more money invested in bonds than there are in stocks. Minimally 3 times. So the bond markets are very important. It's a very important tool that the Fed uses, and they look at the economy. They're going to raise or lower interest rates, and they haven't touched the reserve requirements yet. But if they ever do that, now that's when you're going to see some real volatility. They haven't even talked about doing that, so that's good. That's something that they do when things are really getting out of hand. They'll actually start restricting how much money the banks can lend by increasing the amount of reserves they have to keep at the Fed. Every dollar that they require in addition to their current dollars is a dollar that can't be lent out. Okay, it's going to get that crappy Fed funds rate. And so when there's less supply available to the banks, they've got to raise interest rates to make up for it. That's why you had such super high interest rates. That concept had not really been employed to the level and the extent that it had been in the late 70s, early 80s. And boy, did that work. I mean, mortgage rates were at 22%. I hear people saying, oh, they were only 18. They weren't 18. A money market was paying 18. A money market, the equivalent of a savings account, paying 18%. That blows my mind. And mortgages were 22. And the only people that like to argue or want to argue with that are the ones that don't want to ever think that can ever happen again. You know how little kids put their hands over their ears and I'm not hearing it. And same thing. So, but I remember because my dad was a carpenter, and the housing market just got crushed. People were looking at the cost, on the interest cost of owning a home, and it was like, wow. The only people that were building and buying homes were those that had enough money that it didn't matter. And but everything else came to a screeching halt. And I'm so glad there was no internet back then, because it would have gotten a lot more coverage. And most people didn't know. And that was, heck, we didn't even have cable in my neighborhood when that was going on. That is funny. No cable, no internet. Tell that to a 30-year-old. 30-year-old doesn't know what cable is, but probably does, but I'm just kidding. Anyway, I got to take a real quick commercial break here in a few seconds. If you hear anything you would like more information on, or you'd like to come in and get your own, or you can do it over the phone. I can do a financial plan literally in 5 minutes. Now, if you have millions of dollars and lots of trusts and it's really complicated, that's probably more than a phone call. But I'll be glad to give you my opinion on anything. And since I am a fiduciary, a real licensed fiduciary, I have to work in your best interest. And I would do it anyway, just because I like to think I'm a nice guy. But I'm legally required to do whatever is in your best interest. And I'm too young to retire, so I don't want to be forced out of business. So you've got my word on it, and I will try to operate in your best interest and just hear what you're trying to say. And oftentimes, I got to tell you, some people, it's so different. I'll have a married couple sitting there, 2 entirely different mindsets and 2 entirely different sets of goals. Those are the challenging ones, because whoever has the more aggressive personality is really offensive to the conservative one. I had no idea I was going to have to be a marriage counselor when I took this job. But hey, you know what? It comes with the job, and my job is to try to help explain why, maybe you don't want to try to spend 10% a year. And I'll take the wrath for all you spouses out there that, have been avoiding this conversation. But anyway, hear the music. This is Bill Bullington. I'll be right back after these messages.
I love the lights, the trees, the giant parades. I love the joy I feel around the holidays. I love the snow that falls and covers the earth. I love to sing songs of the Saviors.
And we are back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you hear something you'd like more information on, feel free to reach out to me. It's bill@bullingtoncapital.com is my email address. My website is bullingtoncapital.com. Or you can reach me at 330-664-0700. 330-664-0700. And I think the final segment of today, I've had so many requests for this. I feel bad that I haven't, I used to talk a lot about individual stocks. And it's not that I don't watch them or follow them anymore. It's just that it's very, very difficult. Stocks move a lot faster today than they used to. So when I'm going to be looking at stocks, it's not going to be the way that I did in the past, where I would basically be a trend follower. It has a little bit to do with it. Actually, I still use the trend following tools to pick out individual stocks that I think look interesting. But I'm really looking more at a longer term holding period now. I'm trying to look at a stock or find stocks who are on the move, but have a really good reason to be on the move. Like rising sales and rising profit margins and valuations that are not too far stretched out. Okay. And I'm finding more lately, which is kind of nice. And if I could ever get my software to boot up here in the radio station, I would talk about it today. Yeah, you got to love technology, don't you? I'm holding myself back from screaming right now. The technology, I got to believe that there's something going on across the country that they are not talking about. Because we have some of the firms with the highest, they've got the highest security, tons of people, literally thousands of people in tech support. And, the service will go down for 2 or 3 hours a day. And this is, 6 months ago, it was happening almost every day. And now it's happening about every other day. So they're getting a handle on it. But our technology is still going, and nobody's talking about this. And I'm telling you, and I know the people at home, when they're having problems, they probably think it's something that they're doing. And they love to make you believe when you call into a call center that it's something that you're doing. Well, I know a little bit more about this than the average person does. And I'm telling you, a lot of this, it's bad code. They're timing out or slowing things down so that they can make changes and upgrades, and they don't tell you about it. And eventually it'll come out that, oh yeah, we made an upgrade, 6 months ago. Oh, that's why I was having such a hard time. So don't worry about it. If you're not able to log on to stuff right away, just keep trying. That's one of the benefits to having accounts at Bullington Capital, because we link all the accounts that we manage and we can see them. And actually, within a few months, we'll be able to create a client portal where you can see all the accounts in one place. Now, you can do that with some vendors, but you can see the accounts that they have at their firm in one place. You can't see accounts you have at other firms. And actually, some of them have services now that you can use where you can link up all the accounts that you have in one place. They're very difficult. I am always testing those. When it's really running well, I will roll that out. But so far, the tech support on that, you'd actually have to have a couple of full-time people helping everybody reset up their access to all their accounts all the time. And that has not gotten a whole lot better for companies that provide services for people like me. And at some point in time, we'll be able to do that. And I think that time's getting closer. And I think it's going to be very helpful. But for now, we can do everything, all the accounts that we have. So we've got a few different, probably, I think 4 vendors. So we can pull in from those 4 vendors, and you can see everything you've got with us in one place. And you can see how it's broken down. You can actually do a deep dive into it, see what the top positions are. There are tons of reports that are available on it. It's interesting. Kind of. I guess if you're a nerd, it's interesting. You want to see what makes up your portfolio, which I think is really kind of funny, because you're going to see a lot of the same stocks in a lot of funds that people think are different, and that's one of the things I think is kind of funny. People will send their statements and say, "Can you take a look at this?" And I'm looking at it, and I've been doing this for so long. I'm like, wow, those funds are from different companies, but 80% of the stocks are the same. You're not really benefiting that much from being spread out like that. It will increase the complexity of your tax returns, and you're not gaining a whole lot as far as diversification goes. So, in fact, it is funny. If you bought the Russell large cap, mid cap, and small cap indexes, and you did them equally, you'd cover the entire market. That would literally cover the entire market. Now, maybe you want to be more specialized. Like I'll overweight healthcare, and I've been overweight semiconductors now for several years. Why? Well, if you look at the underlying industries, their sales are growing faster than the other industries are. And think about that for a second. If your sales are growing faster than sales of other industry groups, shouldn't your share prices appreciate a little bit more quickly? I mean, think about it. You're growing 20% a year, which means every 4 years you're basically going to double in size. Someone else is growing at 5% a year, which means in 4 years you'll be about a quarter more productive. What would you rather have, 100% productivity increase or a quarter? And common sense, right? Now, put those into stocks, the opposite may happen. If something scares somebody bad enough, normally the companies with the slower growth rates are the older, bigger companies. Okay, they will have a tendency to be more resilient than the young, fast growers. Everybody gets afraid that they're going to go away, so their share prices will actually drop more. And I know it doesn't make sense. The young, faster growers should continue just to shake that off. I agree. Unfortunately, that's not how it works. And boy, does it take you some time to get your head around that. If you ever do, most investors don't. Most investors don't realize too that a mutual fund where you had a bunch of mutual funds back in the day that were just blistering. I mean, they were putting in such good returns. And when those funds all reached about $1 billion in assets, suddenly the returns slowed down. Well, yeah, because back in those days, they had to get out of the small and fast-growing companies because they had so much money to manage. They had to start buying the older, bigger, slower growers. And that's a problem. I mean, now you're holding stocks that, weren't the type of stocks you did to produce those numbers. And guess what? Those numbers are going to be a lot slower. So today, it's a little easier. You can focus just on certain categories and know that that's what you're getting. Now, the categories themselves are changing over time. What used to be a microcap stock today doesn't even exist anymore. And a microcap or a small cap or microcap today is a stock that's value is under $500 million. $500 million bucks. That's called a microcap. That means it's really, really small. And I guess when you look at the size of companies like Google and Microsoft, yeah, it's pretty small. So, but $500 million bucks, and I would have thought that would have been a big number. And by the way, when I first started in the industry, that was a big number. So there were actually about 2.5 times more stocks available to invest in as well. But anyway, let me get off that for a minute. Anyway, so you just want to you want to have a really good diversified model in the long run. the company's value has a tendency to keep up with the growth in sales and profits. That's over a 5 or 10 year time period. That correlation between sales growth and share price appreciation gets higher and higher and higher. Anytime underneath 5 years, I think the correlation coefficient was like 0.3. What that means is roughly 30% of the stocks actually kept up with the growth, and 70% were really different. And so you couldn't really rely on that a whole lot over a 5 year time period. And you think about that. The average investor comes, asks, what do you think the market's going to do in the next 12 to 18 months? Really? You got a quarter? But so you really need to be looking out over extremely long time periods. I know that it takes a lot of patience to do that. That's one of the things where rebalancing comes in play in very handily. When the funds are doing it, they're doing it on the types of stocks that they hold. When you're doing it on the whole category. And should you do that? Yeah, probably about once a year, once every other year. Actually, I'm not even sure why it tests better. But when I run the back tests, every other year has actually been the better rebalancing period. Go figure. So, but doing it more than once a year, I think you're going to hurt yourself. When I look at a lot of the studies done on that, a rebalancing period that's too frequent oftentimes leads to, first of all, unnecessary taxes, which really hurt your returns. But secondly, it hurt the overall return. And I'm like, wow, that's pretty interesting. So anyway, if you'd like to figure out for yourself or have some help, how should I be investing? I'm 65. I'm going to be retiring in 2 years, or I'm retired now. This is how much money I have. Here's how much money I have in Social Security. Okay, literally, it's going to take me I don't know, as long as it takes to pull up the software. But as soon as I can punch that in, it's not a lot. I can tell you what the sustainable income should be. You tell me whether you are a conservative or moderate or aggressive investor, and I can explain the various options there. And it shouldn't take a whole lot of time to do this. I know for a lot of people, it takes a lot of time just to answer the question, are you an aggressive, are you conservative? Because they don't think in terms of risk, they think in terms of return. And they want the higher return. And they struggle because they're typically a conservative investor. Or if they're going to have conflict, it's because they're a conservative investor. And it comes back down to that thing, wants or needs. I know everybody love to have the really high returns. Everybody wants the really high return, but you may not need it, and you may not be able to put up with the amount of risk you would have to take to generate those returns. So until people get that down, and by the way, one of these days, there's going to be a product out there. It's going to hook you up to biometrics, and it's going to talk to you, and it's going to show you your portfolio. And actually, you'll probably be wearing some of those glasses that the kids wear for the 3D games. I'm going to have to finish this after these commercial messages. Oh, then I'm going to have to finish this next week. That's the end of the show. I can't believe it went that fast. It's Bill Bullington. Feel free to reach out to me, bullingtoncapital.com. Have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.